And welcome to the Nerdy Agent Podcast. I'm your host, Luke Pedersen, with my brothers and fellow nerds, AJ and Josh. AJ's getting out a quick communication to the team.
Nerds back.
To make sure that our agents are staying on top of what they're supposed to do. How many agents do we have this year with the sale? It's been a while since we've been on. 3-4 weeks.
Our roster is at 46 agents right now, and I would say about 35 active.
And how many have a sale, though?
It's like 20-something.
What's the date today? January 8th?
It's
What's the date?
It's
That was 24?
25 agents have sold a house this year, I think.
Okay,
I just
heard
looked,
26.
actually, we have 15 with 2 or more sales already.
Wow. So it's gonna be a fast-paced year. We're gonna plug it pretty early just because we are growing pretty fast. We're onboarding like 5 agents probably right now as well.
Yes.
There's a lot of movement in the real estate industry as 2025 has started. If you're interested in seeing what that looks like, come by a team meeting, shoot us a message. We'll let you know when they are, or just show up at 915 Main Street in Hopkins at 10 o'clock on Tuesday. And we'll see you here. You don't
At
need
least
to tell
right
us
now, but we might need a bigger office pretty soon.
Well,
here.
we will. We might need to give you a new address. Today we are going to talk about we like to say crystal ball. Obviously, nobody really knows what's ever going to happen, but our predictions on what 2025 might look like from a interest rate perspective, what the Fed's going to do, what the economy might do, and also what that's going to mean for you in the market with buyers and sellers, what that might be looking like as well. So I think a good jumping off point is going to be talking about the rates, because the 10-year did some interesting stuff this morning, and the jobs report, what that looks like.
Woofda.
Who wants to take it?
Jobs report was 100,000 jobs high. The 10-year Treasury yield we talk about often.
And so back up.
Go ahead.
That means every time the jobs report comes out, there's a prediction on what they think the jobs report might be.
I think it was
there's an actual number.
I think the estimate was 155,000 jobs added in December, and I think it was 258,000
was
got
what they
added.
actually added.
The 10-year Treasury yield, which basically determines the 30-year fixed interest rate, I mean, they just follow each other very closely, is at a 52-week high. For those that don't know how the calendar works, that is a full year. So that's really high. It's almost at 4.8%. At the low point in 2024, I think we got down to like 3.6. That was when rates were hovering around like 6.25 to 6.5. Mortgage News Daily doesn't publish reports of mortgage rates until like midday. I'm guessing we're going to be somewhere close to 7.25 today.
The rate sheets probably are out now.
Yeah.
My lender was saying they were coming out in about an hour. I talked to him about an hour ago. For those who also, just so if you've new to us or don't necessarily remember, what's going to happen is those jobs reports come out. There's more people that have jobs than they were expecting. When more people have jobs, theoretically, more people are spending money. When more people are spending money, theoretically, inflation continues to go up. When inflation continues to go up, the Fed might be less likely to be aggressive with cutting the overnight rate or some of the stuff that they might do. They might hold or what have you. And that then indirectly affects what the secondary market's going to choose to do.
Yep.
And so that's why the 10-year maybe would go up when the jobs report comes out high. There's obviously been revisions in the past. I don't know. You were talking about that earlier. I don't know if that's going to change anything.
We'll see. They revise that over time. Usually it's the big bump, though, happens when the first report comes out, and the revisions tend to be a little bit quieter. But then when they kept happening and people said, well, the economy is actually not as strong as it seems from the initial jobs reports that have been released, there have been some pullback periods within the 10-year. So yeah, that's
what's interesting though is we've been, throughout this whole process of the rates going up, we've seen the spread between the 10-year Treasury yield and the 30-year fixed rate be like 280 to 300 basis points, which means like if the 10 years at 4.25, the interest rate's at like just over 7%, so 2.8% higher. Right now, what we're seeing is actually a massive compression on that number back down to more like somewhat historical norms. So you're seeing if the 10-year Treasury yield's at 4.8 today, let's say it tops out at that. If the rates are at 7.2, that's 2.4% higher or 240 basis points higher. So it's like almost half of a point lower on that spread than it has been over the last couple of years. For reference, between 2010 and 2020, when the Fed was actually buying mortgage-backed securities, I believe that's called quantitative easing. Mm-hmm. That spread was like 160 to 190 basis points, or 1.6 to 1.9%.
Why would that spread be larger or smaller?
So when the Fed has unlimited amounts of money, I mean, not really, but kind of, right? Mm-hmm. And so if they are a buyer in that tertiary market, I guess if you call it, or third or fourth marketplace where they're buying these tranches of mortgages. When you're originating loans on the front end, if you know that there's a buyer on the back end for sure that has like an unlimited piggy bank, you're more willing to take a little bit lower of a margin because you know you're going to make money anyways. If they're not buying mortgage-backed securities like they haven't been for I think like 5 years now, then you don't know if there's going to be a buyer because it's more of a private marketplace where there's buyers and sellers that are just investors. If you don't know that there's necessarily a buyer on that back end, then you can see how they would want to get a bigger margin to know that when they're selling it, there might be a little bit more bid and ask kind of negotiations, or the marketplace is moving downward on buying those mortgage-backed securities.
I'd imagine the Fed probably is willing to take a lower margin too than maybe like a private investor.
I don't know how that all works. Like I'm not like in tune enough with that, but just knowing that, like, I mean, if you think like if I buy a house and I know I'm going to sell it and I know that there's going to be a buyer that has an unlimited piggy bank on the back end and I'm buying it at market rate, then I'll pay market rate if I'm going to get market rate plus 1% because I'm making money every single time that I'm doing that. Whereas if I'm paying market rate, but I don't know that there's a buyer that necessarily wants to take on that house, then I'm probably not likely to pay market rate. I maybe will pay market rate minus 2% or whatever, because then I can resell it and make some money. So that's when you see those compressions and those spreads widen out. But it has been coming down, which is super interesting to see.
So moving forward then from an interest rate perspective, obviously nobody really knows because those reports are hard to understand why they come out one way or another. Where do we think that's going to go in 2025? I remember at the beginning of 2024, do you remember at the beginning when everybody was like, the Fed's going to cut the rate 6 times and it's going to go to like 5 by the end of 2024.
Every single agent on Facebook's like 5.5%.
Remember that?
Yeah, I looked back because I don't post a lot on Facebook. I posted something on Facebook a couple weeks ago or a week ago. And I was like looking back, like, how often did I post here? And I saw a post from October of 2023 where I kind of slammed, because there was that meme going around of like, if you think buying a house is bad now, just wait till rates are 5.5 next year and there's 6 buyers for every house and whatever that. And like 100 agents had posted on my timeline and I was just frustrated. But that was like, a year and a half ago, and everyone's like, this is definitely happening. And you're like, no, that doesn't, there's no guarantees, right? Like, and I will stick to that in this conversation today, especially with uncertainty that exists more broadly speaking right now. It's any agent that posts something definitively saying that things are going a certain direction, or real estate broker, et cetera, mortgage lender, like it's irresponsible. So be thoughtful about how you communicate that.
And I mean, like, that's what we've always said is like, we don't know. I think long term, the one thing we can probably say is we think at some point in the future, the rates are going to be lower than they are today based on historical data and the norms and the fact that we are probably at some point going to enter the end of the bull cycle that the economy and the market has been having. We just don't know when that's going to happen. And so to say, like to Josh's point, to say like that's going to happen in 6 months, like is so irresponsible because everyone thought that there was going to be 150,000 jobs added and there was 250. Like we don't have any control over that and we don't know what's going to happen.
The people who know the things and create the estimates were off by almost 30%. We're off by 30%.
40%.
40%.
50. Yeah, it's a lot.
And let's be honest, guys, like in less than 2 weeks, there's going to be a horse in the hospital again.
Yeah.
No one knows what the horse is going to do.
Yeah, exactly.
So that's going to actually make a difference.
Yeah. So if we were to say, though, at the end of 2025, we're talking in December, do you think the rates are lower than they are right now?
I would guess that they probably are. But, talking with like our financial planner, it's like he thinks the market's going to really rip this year. And if that happens, you could see a world where the rates are kind of similar to what they are today. I do think from a real estate perspective, though, the longer you get into this high rate cycle, the more sales that are going to happen. Because what happens here is if we get 3, 4, 5 years into a cycle where the rates have been over 5%, let's just say.
I mean, over 6.5.
Right, but over 5. If you look at 2022 is kind of when this started.
Yep.
Some of the people that bought in 2022 are going to start selling in 2025. You have this incentive thing, right? And so when you look from a micro perspective, the incentive to sell for me with a 2.25% mortgage rate is very, very low. Now, if I bought a house in June of 2022 when the rates were at 5 or 5.5, I think is probably what the number was. Well, the spread between 5.5% and 7% is not quite like it's not nearly as much as the spread between 2.25 and 7. So you have some of these consumers that will say, I mean, I don't have that great of a rate right now, so why not make the move when it makes sense for me? The longer you get into this higher rate cycle, the more likely people are to sell their house and buy a new house. So I do think sales will not quickly accelerate, but they will. Like, I think we've bottomed out on the real estate
because to your
sales side.
point, the median rate is going to be increasing over time.
Exactly.
And so unless there's a drastic shift backwards, but that actually would increase the opportunities to sell because the spread would decrease between the 3-4% people and the 5-6% people. But the reality is like the median's going to keep coming up until we get to a point where it becomes more palatable. There's also the reality, and we've said this, that at some point, anyone who's been sitting on the sideline has been growing less and less comfortable with their situation. If you're somebody who is only not selling because of rates, at some point you're going to go, yeah, rates are going to be what rates are going to be. My level of discomfort has gotten to a point where I don't want to keep doing this. It's been 2 years, or 3 years. Like every year that passes where rates stay high and you're looking at that spread going, I don't know if I can sell. At some point you might just pull the trigger because you're going, I don't want to sit on the sidelines anymore. Or this house doesn't work for me anymore. Yeah.
You're talking about someone who maybe didn't have a kid and now has 2.
And living in a 2-bedroom house, right? Like, I don't know.
That's a huge difference.
That will boost some market activity. When you talk about rates, though, where they're going, I think there is a long-term. I'm of the belief that there's a long-term point at which rates get into the 5.5 to 6 range, and the market kind of becomes more stable. That is highly dependent upon global economies and stabilization because we're still post-COVID and dealing with all of the weird fallout of what happened there. The inflation stuff is still ongoing that was all impacted during COVID. And so there is a normalization point that is at some point, I believe, going to come. But if you ask me if rates are going to be higher or lower in 2025, I would say I'll flip a coin. Like I think by the end of 2025, there's a 50% chance that rates will be higher than they are today, and there's a 50% chance they'll be lower. Generally, I think they'll sit within a pretty narrow band to where they are right now.
Do you think they could clip 8?
Yeah, there's absolutely. I mean, like, let's say we go crazy on tariffs, and then things go really weird, and yeah, there's absolutely a world in where they could go up even further.
I mean, but check out this chart. This is wild. Like I'm talking about total sales.
I was wondering that compared to 2008.
All-time total sales. The worst was actually 2011.
Sure.
When sales were at 38,000.
This is in the Twin Cities market, so this isn't nationally.
This is over a 12-month period of time. 2008, they got down to about 38, 39,000. 2011, they got down to like 36, 37,000. In the last 12 months, we're only at like 44,000 sales.
What's 500 divided by 44,000?
500 divided by 44,000?
500,000 or just 5 times?
Oh, you mean like our market share?
Yeah.
Times
100?
0.1%. No, 1%.
We have 1% of the market share in the Twin Cities. That's kind of fun.
That's pretty fun.
We have a whole percent.
Yeah, and if you look at that and you go, okay, we're actually like most agents are feeling it too. They're saying like this is not good. I've gone backwards. A lot of people I talk to, we're at nearly the housing crisis number for sales. We're only off by a little bit.
And that's what we remind our agents, because we have a lot of agents that have started in the last 3 years, right? And if you're listening to this, you've probably been listening to it for more than a day, right? So you've been listening to us as these years have been happening, because it's been multiple years in a row where the market has been probably as difficult as the market has been. So what we told the agents the other day was like, you dealt with the market taking a drastic downturn when rates skyrocketed 2 years ago, and all of a sudden activity fell off a cliff, and everyone was freaking out post the boom that happened during the COVID years. But if you're still listening, that means you survived that. And then this year, you survived a continuously slow energy in the market and the reality of all of the new changes in processes, procedures, opinions about real estate agents as a result of the lawsuit. And you're still here. So if you've made it through these couple of years, the market should theoretically not have any headwinds that are as huge as what you've been dealing with the last 2 years. Mm-hmm. The market share that's available today should be better than it's been, because it's not like everyone's looking at being like, I should get my real estate license right now.
And there's a lot of people who have fallen off and they didn't make it.
And same thing with the lenders, right? Like it's the same opportunities exist on that space. It's gobble up market share, and then at some point it'll get easier.
Yeah, we like giving knowledge and creating value for you so you understand things. We don't love plugging ourselves too often, but I will say you're talking about worst market since what was it? Was it called the Great Recession? Is what it was called, right?
Yeah.
Since the Great Recession from a sales perspective, and to all the headwinds, what that looks like. We have a lot of agents that started during this time, and they've gotten to 10, 15, 20, some of them 30 sales when they literally started their career. And we talked a lot in 2024 about the fact that we felt like 2024 was going to be a year where a lot of people were going to be looking for change from a real estate perspective, where they're at maybe isn't working, trying to find something that's going to work better. I don't think it's as much in 2024 as it will be in 25 from what we've seen so far. I think more people are thinking about this as they get into 2025 right now, especially when sales are going to start to uptick. They're going to try and figure out where they can be a part of that. And on our team, you can be a part of that. Like, it's pretty consistent that we've proven that this works.
We only lost 13 transactions to people leaving the industry.
Yeah, and what's interesting is, like, you talk to a lot of people
crazy.
who are seeing, saw their sales either in 23 or 24 evaporate. Like, I'm talking, we go through the broker metric type stuff. It's like 20 sales down to 6 in a year, just because they didn't have a diversified enough business. And to Luke's point, we had one agent on our team this year start mid-year in 23, sell 8 houses and sell 32 homes in 2024. First 2 years in real estate. In a market that was almost half.
It's like she started real estate in 2008.
Correct.
Or 2009. Like, that's the comparison. So if you are thinking about it, we don't love to plug too much, but there you go. So we think that this market moving forward, 50-50 on rates. We think more people are going to be in the position where they bought a house, the rate was already high, so they might be in a position the next couple of years where they're going to start selling their houses. We think more people are going to enter the market from the sidelines.
I think the sidelines is the important one, because there's some stubbornness going on where it's like 22, 23, 24. You're like, rates are 7, I don't have to move. I mean, but I'm thinking about it. If you get 3 years down the road, now you're really in a position where you probably have to
Maybe
move.
gotten a few raises.
Exactly. And you're going, I'm just going to do it now. I don't know when the rates are going to get better. I think there's going to be more people like that as well.
I think
eventually.
Pending sales listings will both be higher this year than they were last year. I don't think drastically higher, but I think they'll be higher this year than they were last year.
Like 8 to 10% or what?
I don't think they'll be that much higher than they were last year.
I think 10%. I'll make a prediction.
There you go. We'll talk about this in 25.
10% more sales this year.
Price growth will be minimal as well. I don't think it's going to go backwards, but I do think it will be minimal.
It'll be pretty flat.
You would actually argue that what you're talking about is what's going to create more flat, because part of the reason why we've seen the appreciation is because of the lack of people selling their houses.
Correct.
So
and the low rates.
And the low rates, whereas when we see people entering the market, they're going to be more thoughtful about the prices they're probably paying as well, because their rate is high and their monthly payment matters. I've actually seen on every transaction I have in 25 so far, the percentage is below 100. I've had some pretty low percentage
to list price.
Yeah. So you're seeing it a lot more often, and I think this year we will see. I agree with that. Is going to be maybe less crazy multiple offers. I argued in 2024 that I saw it more than I thought I was going to. So hopefully that gets better in 25. But
And Luke's already sold 7 houses in 2025.
that's where we're at. Not closed, pending and closed. And our team is going to get to, what's the projection?
620.
650.
700. You heard it here first. If you join our team, that's going to be what pushes it over the edge.
Yep, that's it.
That's all we have this week on the Nerdy Agent Podcast. And as always, remember, be better.
Bye-bye.